The screen splits wide open, left side's a Tokyo trading floor, screens flashing red like a neon stop sign. Right side? A silver futures contract at $34.70, then, in what feels like a blink, it's vapor. The price just vanishes, crashing to $32.82 before the ticker locks up hard. A price error warning flashes like a digital seizure. The audio hits you like a freight train. Keyboard clacks gone wild, distorted voices screaming, "Sell, sell." Sell, then a trader's raw, ragged voice cuts through. It's gone, all of it just gone. The right screen zooms in tight on the numbers. This isn't a dip, it's a slide. $34.70 to $32.82 in 17 seconds flat. That's not a correction, that's a wreck. The terminal glitches again hard. The trader's mouse cursor spins like a broken top, dead in the water. The screen flickers, then goes black, silence, then thud. A phone slams down. A shaky voice mutters, 3 million gone in 30 seconds. 5.6%. That's the number that shouldn't exist. 5.6%. The silver market just erased 5.6% of its value in under 3 minutes. Not a typo, not some digital hallucination. 5.6%. Poof, roll it back. Spot silver, actual silver, the real deal was sitting pretty at $21.50 an ounce when the floor dropped out from under it. Then, a free fall. $20.30. $19.80. By the time the dust settled, the damage was locked in. 5.6%. That's not market noise, that's a slaughter. Now pull back. This isn't just silver. This is the whole precious metals world screaming into the abyss. Futures contracts bleeding out. Stop-loss orders falling like dominoes. Trading bots firing off sell orders at lightning speed, not because of some grand scheme, but because the algos saw an opening and they took it. But here's where things get really strange. Because this wasn't some rogue algorithm running wild. This was a flash crash, the kind you usually see in stocks, not commodities. But silver? Silver's supposed to be solid. Silver's the metal you hold when the world's falling apart. Silver doesn't move like this. Cut to a regulator's findings. The CFTC's 2024 Market Volatility Report. The government's own words says it plain. Commodity flash crashes are increasingly tied to algorithmic trading during low liquidity stretches. Translation: the machines hunt in packs, and when the prey stumbles, they don't just nibble, they rip. Source: CFTC 2024 Market Volatility Report. Now here's the kicker. This wasn't a one-off. This was part of a pattern. Silver had been twitchy for days, bouncing up and down like it was caught in a hurricane. But on this day, something snapped. A single trigger, a liquidity drought. And then boom, the bots smelled the blood. Bloomberg's on this too. They track every tick in every market. And they put it bluntly. The sudden plunge sparked debate over whether high-frequency trading algorithms amplified the move in a thinly traded market. Thinly traded, that's the real issue. Silver isn't gold, it's not a liquidity beast. It's a market where big players can move the needle with one order, and when the algos see that thin liquidity, they pounce. Cut to a study peer-reviewed, published in the Journal of Commodity Markets, not some random blog rant, science. The findings, flash crashes in precious metals, aren't accidents. They're triggered by rapid order book imbalances from high-frequency trading. In other words, the machines are turning commodities into a shooting gallery. Source: Journal of Commodity Markets, DOI, 10.1016/J, JCOM, 2023 100,567. But here's the thing, this wasn't just abstract market madness. This was real money, real losses, real panic. Traders who'd spent decades in the trenches watching their screens go dark. Funds that bet everything on silver's stability now underwater. And the worst part, nobody saw it coming. Because here's the dirty little secret nobody talks about. Most of these experts, they're guessing. They look at charts, at economic data, at Fed policy. But they don't look at the machines. They don't see the algorithms quietly rewriting the rules. Cut to a terminal. Silver futures are back online, now trading at $20.90. A partial bounce, but the damage is done. The algos have already moved on. And somewhere in a server farm in New Jersey or Chicago or Tokyo, another bot is waiting, watching, hunting, because that's the truth about flash crashes. They don't happen once. They happen again and again. And every time they leave a little more wreckage behind. So who missed it? Who failed to see this coming? And more importantly, what happens when the next one hits? The screen fades to black. A single keyboard key presses enter. Then nothing. This is a dramatization based on real events. Past performance doesn't guarantee future results. Trading in commodities comes with serious risk and isn't for everyone. All right, let me paint you a picture. It's March 29, 2024, to be exact. Silver's just hanging out at around $22 an ounce, you know? Then bam, in what felt like the blink of an eye, it plummets 5.6% down to $21.50. And get this, it wasn't some slow, drawn-out slide. Nah, this was a full-blown flash crash straight out of a nightmare. By the time the dust settled, it clawed back some ground, but the damage already done. Now, here's the twist. This wasn't some random market blip. Nope, this was like watching a playbook unfold and the players, total wildcards. Let's rewind to 2010 for a sec. Remember the flash crash? The E-mini S&P took a nosedive, dropping 6% in minutes. The culprit? High-frequency traders, HFTs, exploiting those sneaky low-liquidity windows. Fast forward to 2016, hello, sterling LBO flash crash. Same script, thin liquidity, millisecond advantages, and algorithms running wild. So when silver tanks in 2024, not a coincidence, it's déjà vu, and Dr. Alina Voss, she was the one who first called it out. What you just saw, she says, voice dropping to a whisper. That wasn't a glitch, that was a hit. On her whiteboard, 3 cases laid out like a detective's board. 2010 flash crash, 2016 sterling LBO, 2024 silver crash. All sharing one eerie trait: low liquidity windows, HFTs with their millisecond advantages, and a market just waiting to break. But who's really pulling the strings here? Let's lift the curtain. Say hello to Marcus Chen. He spent years building the machines that now run the show, and get this, he told me flat out. These algorithms, they don't care about whether silver's supposed to be worth this or that. They care about latency. Here's the thing about silver, though. It's not like gold, way less liquid, way more fragile. Fewer buyers, fewer sellers, and when a wave of sell orders hits, poof, the price just evaporates. And in a market that thin, every millisecond is a knife fight. Chen broke it down like this. Think of a packed stadium, everyone trying to bolt for the exits at once. The exits are tiny, the doors electronic. If one door opens a hair faster than the others, that's the one everyone stampedes through. That's your flash crash. Now, the CFTC's 2024 Market Volatility Report. It's got receipts. Says commodity price flash crashes are increasingly tied to algorithmic trading during those low liquidity moments. And a 2023 study in the Journal of Commodity Markets, even more damning. It found that flash crashes in precious metals, often triggered by HFTs, creating instant order book imbalances. So how does this actually go down? 3 steps, like a heist movie. Step 1, the setup. Silver's already in a low liquidity window, maybe a holiday weekend, maybe the futures market's half asleep. Step 2, the trigger. A flood of sell orders hits, could be a big player unwinding, could be a rogue algo misfiring. Doesn't matter, what matters is the reaction time. Step 3, the exploit. The HFTs see the imbalance and whoosh, they're in front of it, selling into the panic before the price even hits rock bottom. And here's the kicker, this isn't just some wild theory. The data's staring us in the face. Bloomberg ran the numbers and called it out. The silver drop sparked a debate over whether HFT algorithms amplified the move. MarketWatch piled on, noting the flash crash lined up exactly with a spike in sell orders from automated trading platforms. So it's not just some analyst crying wolf. It's happening, and it's getting worse. But why silver? Why not gold? Easy, gold's got layers. Silver, it's the thin ice of the market, less liquid, more volatile, perfect for the algo sharks. And in a market like that, even a small imbalance can set off a landslide. So who gets left holding the bag? The little guys, the retail traders, the folks just trying to save for retirement. They're the ones left staring at their screens, jaws on the floor, wondering what just happened. Meanwhile, the big players, already bylaid, their orders filled before the crash even registered. And that's the game, folks. It's not about who's right or wrong. It's about who's fastest. Who's got the low latency, the high-speed connections, the servers parked next to the exchange. Who's got that millisecond edge? Because in a market like this, speed isn't just an advantage, it's a weapon. Dr. Voss nails it. This isn't trading. It's warfare. Dr. Voss's monitor flickers like something out of a slasher flick. Just her, the shadows, and that live feed where silver's bleeding out before her eyes. The numbers flash by so quick they practically smear. One moment it's 2340, the next 2150. A 5.6% wipeout in what felt like the blink of an eye. Source, Reuters. Her fingers pound the keys. What in the actual hell just took a dump on my screen? The screen erupts with a heat map, red spikes everywhere, like a downtown losing power all at once. But here's the twist. Most of those sell orders didn't come from flesh and blood traders. They came from bots. Algo herds moving in perfect lockstep. The display splits clean in half. Left side's raw market data, right side's Dr. Voss's simulation with its flashy predictive overlays. She hits play and suddenly it's all happening again, just faster. Circuit breakers screaming bloody murder, liquidity vanishing into thin air, prices ricocheting like a pinball with bids that disappear before you can even blink. Source: Bloomberg's also waving the same red flag, high-frequency traders dumping silver like it's a hot coal during a low-volume window. Automated platforms treating the metal like a radioactive potato. Dr. Voss zooms into the order book. One little cluster of trades, tiny, lightning fast, selling the exact same fraction of an ounce. Too neat for humans, too coordinated for coincidence. She slaps a label on it. Entity 9X, a tag the SEC's had on its radar for months. A phantom in the code, no paperwork, no registered entity, just a trail of orders that last 1 millisecond each. She calls up Nexus Capital. Front door's a shell LLC down in the Caymans. Real owner, buried under Delaware Trust so deep you'd need a miner's helmet to find it. But the trading footprint, identical to what we saw in gold's wipeout last quarter. Same ghostly scribble in Platinum's collapse last year. She squints at the screen. This isn't some glitch. This is a targeted strike. The simulation flips gears. Entity 9X isn't just selling. It's actively tripping circuit breakers to manufacture fake crashes, then scooping up liquidity at fire sale prices before flipping the spread faster than you can say margin call. The screen erupts, circuit breaker activated. Price freezes at 32.82. Recovery's already starting, but the damage already baked in. Dr. Voss's cursor lingers over the final overlay, Nexus Capital's trades versus every circuit breaker timestamp from that day. The connection isn't just strong. It's a 0.98 match. She exhales through her nose. They're not trading silver. They're turning the whole market into a weapon. Source: CFTC's 2024 volatility report confirms flash crashes in lightly traded commodities jump 300% when algo order imbalances hit critical mass. Source: peer-reviewed study in the Journal of Commodity Markets shows high-frequency trading sets off 89% of precious metal flash events. She hits the last layer. Nexus Capital's top dog, a holding company tucked away in Luxembourg. And here's the kicker: Luxembourg's financial cops can't touch this thing with a 10-foot pole. It's untouchable, a specter with a trading algorithm and a playbook. Dr. Voss slams the laptop lid down. We just witnessed the crash, but the real gut punch? The crash isn't in the price. It's in the entire damn system. Here's the wild part. If Nexus Capital could yank silver poof down 5.6% in minutes, just cause an algo spotted a gap and took the shot, what's stopping them from doing the same to gold? That's not fear talking, that's the raw numbers. Silver, $21.50, down 5.6%, vanished. And hold up, sources confirm it wasn't some freak glitch. It was a full-on ambush. High-frequency traders turned the market into a shooting range when it was half asleep. Orders stacked up in the blink of an eye. Selling pressure steamrolled the bid. Silver got turned into target practice. But here's where things tilt sideways. Regulators, they're still stuck in the mud. The CFTC flat-out admits flash crashes in metals aren't flukes anymore, they're a trend. Their 2024 report lays it bare. These drops line up with algos running wild when liquidity's thin. And the data doesn't lie: sudden order book imbalances, then whoosh market in freefall. So ask yourself this. If silver can tank 5.6% in 4 minutes flat, what's gold's breaking point? $2,350, $2,200. The screen screams, gold, $2,350, next stop. The clues are all there. The warning signs are flashing red. But the big players, they're not chatting about it. They're moving. And they're not asking for your blessing. So here's your play: dig into the order books. Watch for those algo spikes. Cross-check the charts. The truth isn't hiding, it's lost in the static. Don't wait for the next crash to wonder why.